most of these commodities, it's always a China story, and gold is a China story. The retail investing and speculative positions are being taken in China. So you have the big story, a lot of gold, central bank de-dollarization going on with reserves being built up, but it's the retail side of the Chinese market that's really causing this. So that could be stage one. Maybe stage two is that the retail side in the West picks up.
SteveHanke is an American economist widely recognized for his economics and monetary policy expertise. SteveHanke mentions the gold market's fundamentally bullish outlook, driven mainly by China's retail and speculative demand. While central banks in China and Russia are significant buyers, Western demand has been flat. SteveHanke suggests that increasing Western retail demand could further boost gold prices. Western investors are finally positively impacting the gold market, or at the least, they are not getting in the way of higher prices, according to one market analyst. In his latest comments on the gold market, Carsten Fritsch, precious metals analyst at Commerzbank, said that current market conditions, while supportive for gold, do not fully explain the precious metals rally to a new record high above $2,450 an ounce. In his observation, Hanke states that the increased sanctions are ineffective protectionism, contributing to global economic instability. This growing uncertainty makes gold an increasingly attractive investment as people seek stability amid geopolitical and economic unpredictability. According to the Wall Street Journal article, gold prices were underpinned by buying from emerging markets' central banks. The catalyst that sparked the buying was Western sanctions on Russia after it invaded Ukraine. The World Gold Council revealed that central banks added around 2,200 tons of gold and metal since the third quarter of 2022. In dissecting the current state of the gold market, Hanke attributes its positive outlook to the backdrop of COVID-19 lockdowns, shifts towards green energy, and geopolitical tensions in regions like the Middle East and Ukraine. Now, we present you the clips of SteveHanke's insights from his recent interview with Commodity Culture. Before we continue to delve into this discussion, please subscribe to our channel and activate the bell icon for timely updates.
It's fundamentally bullish. It's quite interesting if you look at this last run that market has had. People point out the obvious. Central banks have been buying, particularly the banks that are trying to de-dollarize, China and Russia, for example, big buyers. So that's part of the underlying story. But the real part of the story that most people have missed is that the retail and speculative demand for gold, it isn't coming from the West. It's actually, if you look at ETFs and bullion sales and gold coin sales, that kind of thing, it's pretty much flat to down a little bit. It's not on the weak with a capital W, but weak with a small letter. But China, like most of these commodities, it's always a China story, and gold is a China story. The retail investing and speculative positions are being taken in China. So you have the big story, a lot of gold, central bank de-dollarization going on with reserves being built up, but it's the retail side of the Chinese market that's really causing this. So that could be stage one. Maybe stage two is that the retail side in the West picks up. I don't think the retail side in the West is going to go down. If anything, it's going to go up, and that could be a second kicker in the market, pushing it up. So the fundamentals are just positive. What can I say? And they're positive because of many things. Recent COVID lockdowns that created a lot of uncertainty people have. This whole industrial policy, state capitalism thing, transitioning to green, all these things are uncertain. Then you've got two wars that President Biden has drugged the United States in, the war in the Middle East and Gaza and Ukraine. The general geopolitical scene is very uncertain because all this protection, sanctions, for example, since 2021, the number of sanctions the U.S. has imposed on foreign countries and individuals, it's increased 900%. And they don't work. Stupidity is doing the same thing over and over again and thinking you're going to get different results. Just a stupid factor, sanctions. And sanctions, by the way, are a form of protectionism, like the tariffs. So once you get this in people's thinking, people think sanctions are a good thing. We're hitting the bad guys: Russia, North Korea, Cuba, Venezuela, Iraq, Iran, and so forth. People think that's a good idea. Well, if they think that's a good idea, they don't have any problem with increasing tariffs, increasing quotas, increasing non-tariff barriers. All these interferences with the state becoming more pronounced, and the politicization of decision making are all around the world. This creates more uncertainty. And when that occurs, gold becomes attractive. People get worried and they want a little gold.
SteveHanke dismisses much of the talk about dollarization as mere speculation, attributing it to the tendency for negative discourse to overshadow positive aspects. Drawing from his experience as a trader in the 1990s, particularly during his time as the president of Toronto Trust Argentina, SteveHanke illustrates the practicality of buying into currencies like the Argentine peso when backed by solid fundamentals and high yields. While acknowledging vulnerabilities like financial sanctions, SteveHanke highlights the resilience of dominant currencies against challenges throughout history, indicating the formidable position of the US dollar in the global monetary landscape. Let's get back to the interview.
I think you read about this de-dollarization every day in the press, but I think it's much ado about nothing. Basically, Gresham's law of talk: bad talk drives out good talk. So, everything you're reading, I think, is a lot of rubbish about de-dollarization. The dollar is the world's currency. Let's face it; it's still the best dirty shirt around. You did get into this adage early on when I was trading, including the episode of operating as the president of Toronto Trust Argentina in 1995, when it was the world's best performing fund. And what's it amount to? Buy dollars, wear diamonds. Now, what did we do? What in 1995 did we actually do? Well, we bought a clone of a dollar that had tremendous yields. It was very cheap at the time, and the yields were, way up in the double digits. And that is the peso. The peso was operating under a convertibility system and trading at 1-to-1 to the U.S. dollar at the time, and it was backed 100% with U.S. dollar reserves. So the peso in 1995 was actually a clone of the U.S. dollar. And why not buy it when the yields were up in way up in the double digits? That portfolio we had at Toronto Trust Argentina, what was it? It was 100% in peso-denominated Argentine bonds. And those peso-denominated bonds, we were in effect buying dollars and wearing diamonds. We knew that the peso was trading at a 1-to-1 rate. It was freely convertible, and we knew what was in the central bank, reserves at 100% to back it up. So it was a no-brainer. At the time, by the way, everyone was speculating against the peso, thinking it was a normal pegged exchange rate that was going to collapse. Well, they didn't understand convertibility and how the system was set up at the time, and they were on the wrong side of that trade, believe me. If you look at a little history of these international currencies, there's always one. The U.S. dollar is the international currency. There's nothing else even close. All the others are kind of footnotes at best. And if you go back 2,500 years, there have only been 14 international currencies that have ever existed. They come and go, but only very, very slowly. If you want to challenge one, it's very difficult to challenge it with something that's superior. Usually the way they go is that bad policies of one sort or another make the king vulnerable. In that regard, there are things making the king vulnerable now. Sanctions, for example, financial sanctions. All these things are making it vulnerable, but I don't think people realize just how difficult it is to challenge. And as I said, 2,500 years and only 14 international currencies. The last one we had before that was obviously the British pound, which was the king from 1820 to 1914. And then after the First World War, it started sliding, and by 1955, it was out. I mean, the U.S. dollar had completely taken over.
UBS analysts raised their gold price projection to $2,600 by the end of 2024. Citi experts forecast that gold will reach $3,000 per ounce during the next 6 to 18 months. How do you think recent economic uncertainties will impact the future of the gold market? And what strategies do you believe investors should consider in response to these developments? Drop your thoughts in the comments section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.